Okay, so now let us take some problems which institute has added in the framework. The solutions are very detailed one, so many people are afraid. So let me help you by solving this. So come to this problem. Your material will have problem and solution, or even institute material will have it. So focus on understanding it. Let's read the question. I hope you got the question from your material, but anyway, even if you don't have material, not a problem. Question is there in front of you now. As on 31st March 2002, Natasha Limited carried trade receivable of 280 crore in the balance sheet. So they have a debtor amount, trade receivable, 280 crores. On that date, Natasha Limited entered into a factoring agreement with Samata Limited, a financial institution, according to which it transferred the trade receivable in exchange for an immediate cash payment of 250 crores. So what you're having now, debtors. And you have done a factoring arrangement. So you transferred this and you got cash. Debtors amount was 280 crores and the cash amount is 250 crores. You understood the meaning of this? Factoring arrangement means you transfer the receivable and they will collect on behalf of you. It's like outsourcing it and they'll give you the money. As per the, it's very similar to bill receivable. Bill receivable also you have the same thing, right? Bill receivable, you go to a bank and you discount with the bank, they'll pay you less. That is called as bill discounting. This is the receivable, debtors. So you call it as factoring. As per the factoring arrangement, any shortfall between the amount collected and 250 crores, any shortfall means if something is they are not able to collect, will be reimbursed by Natasha Limited to Samanta Limited. You understood the thing? I have a debtor. You take my receivables, take this database, give me the money, 250 crores. If you are not able to collect at least 250 crores, whatever the shortfall, I'll pay you. Once the trade receivable have been collected, any amount above 250 crores, less interest on this amount will be repaid to Natasha Limited. So if they collect more, they will pay it to me. Natasha Limited is the company now. Think from my company point of view. If I receive short, if he collects less, I have an obligation to make a compensation. If he collects more, then he will give it to me. The debtors of Natasha Limited are of the opinion the trade receivable should be de-recognized. You are required to explain appropriate accounting treatment on this transaction in the financial statements for the prior year and also evaluate this transaction in the context of conceptual framework. Ideally, you should do this framework not now. After you complete all the standards, right? You come back and you go through this concept once more. You will understand better. Because the problem what we are doing is more related to financial instrument chapter. There we come across problems like this. So once you cover all the chapters, then you come back and do this framework, things will be more clear to you. But anyway, we will go ahead with this discussion. Okay, now my question to you is this. You have a debtor. Should it be de-recognized? Should it not be de-recognized? Continue to recognize. Do you remember what we discussed when an asset should be de-recognized? When an asset should be de-recognized? When there is or when you lose control. Or of course there is no future economic benefits, etc. When the control is lost, that is when an asset will be de-recognized. Now here, that's the judgment, you have to do it. You have receivables, you have transferred it, But if there is a shortfall, you have to compensate. If they collect more, the money will come to you. So do you think you still have the control or you don't have the control? Okay, so when I say control, don't look at just physical control. Look at the risk and rewards attached to that. Because if the amount collected is less, you are still responsible, right? You have to fulfill the compensation for the shortfall. If amount collected is more, you get the extra amount. So you are still the beneficiary. You still carry the risk. Risk is not transferred, reward is not transferred, so control is not transferred. So let's see what the institute has given the solution in detail. Quickly glance through it. Trade receivable fill was a bit of financial assets. Thus, the issue with the factoring arrangement requires to de-recognize shall de-recognize only when the contract right expires or transfers. In the given case, you see trade receivable appearing and expected to be collected. As far as the transfer of risk, we are focusing on transfer of risk and rewards. Factoring arrangements need to be viewed in substance rather than legal form as transfer the receivables, yet it remains liable for making good any for shortfall. And thus National Limited is liable for an entire 250 crores, although shortfall would not be such an amount. Accordingly, it retains the credit risk. It is also explicitly noted that they will be liable to pay National Limited any amount collected more than 250 crores after retaining this retains potential rewards. Pursuant as above, substantial risk and rewards continue to remain. Hence, trade receivable will continue to appear in the balance sheet. Therefore, the immediate payment to be recognized as a financial liability like an advance and shown as such advance as liability in the balance sheet. You got the summary point of this? You have an asset, you have transferred the asset. But even after transferring the asset, you still have the risk as well as reward with you only. Significant risk and rewards are not transferred. So control is not transferred. So you should continue to recognize the asset, and money received, you continue to show it as liability. And when everything is settled, you close the asset, you close the liability. And that is why I told you these problems makes more sense if you can solve this after completing all the standards. You come back and do it, you will understand this problem solution more. So in the exam, you need not write the paragraph number and all. Just important keywords you should use in your solutions. Like you use transfer of risk and rewards, factoring arrangement. I mean, remember there are two types of factoring. I'm not sure whether you remember the financial management terminology there. One is called as, with recourse. Other is without recourse. It's called as with recourse. Anyway, don't worry about it. Use the keywords and give the conclusion always at the end. Solution is there in the material. You don't have to write it down. I hope you got the gist of the discussion. Let's go further. Okay, next. Explain the criteria in conceptual framework for recognition of an asset and discuss whether there are inconsistencies with criteria in Ind AS 38 intangible assets. They're asking whether any inconsistency between the framework and the intangible asset definition asset. So this you'll understand only if you know what is Ind AS 38. That is why I tell you, you come back later also. But anyway, so we'll quickly read through this, what they're trying to tell. Let me explain along with that. The conceptual framework defined an asset as a present economic resource. Controlled economic resource is a right, a potential, produce benefit. Asset will be recognized only if they meet concept framework definition. And information is useful. However, criteria of cost benefit analysis always exists, that is, benefits of the information must be sufficient to justify the cost of providing such information. The cost constraint, if you remember, we have discussed that. The recognition criteria outlined in the concept framework allows for flexibility in application of amending or developing standards. Part 8 of Ind AS 38 says, what is the resource controlled by past events having future economic benefits shall be recognized only if it is probable that the expected future economic benefits attributable asset of the cost can be measured reliably. So two definitions what they've done. So far you understood. They have told definition of an asset as per framework and definition of an asset as per Ind AS 38. They have just replicated. Now the discussion starts. This requirement is applicable both in case of externally acquired intangible asset or internally acquired intangible asset. Okay, that is fine. The probability of expected future benefits must be based on reasonable and supportable assumption that represent management's best estimate of set economic conditions that will exist over useful life of the asset, basically as per management assumptions. Further, probability recognition is always considered to be satisfied for intangible asset acquired in business combination. If recognition criteria are not satisfied, Ind AS 38 requires expenditure to be expensed as and when it is incurred. It is notable that the conceptual framework does not prescribe any probability criterion, as there is future potential to produce economic benefits. Even with the low probability, an item can be recognized as an asset according to concept framework. However, in terms of intangible assets, it could be argued that, read this sentence carefully, I'll read slowly. In terms of intangible assets, it could be argued that recognizing an intangible asset having low probability of generating economic benefits would not be useful to users of financial statements, given that asset has no physical substance. The recognition criteria defined in asset and Ind AS 38 are different as compared to those in concept framework. To put in simple words, Ind AS 38 more specific, but definitely to provide information that is relevant and faithful representation. But when viewed from the prism of relevance and faithful presentation, the requirements of Ind AS 38 in terms of recognition to appear to be consistent with the conceptual framework. Okay, let me just summarize this, then you can read this once more. Okay, Ind AS 38 says, the probability of expected future economic benefits must be based on reasonable and supportable assumptions in the best estimate of set economic conditions. So Ind AS 38 says, when you talk about a recognition of intangible asset, a recognition criteria, you say you have to make assumptions about the future based on best estimate of set economic conditions. But in this concept framework does not talk about this probability criterion. You got the point? That is the difference. Conceptual framework just to say that asset having future economic benefits, and as a result of past event, you're able to control, go ahead. The probability criteria is not talked about a conceptual framework. Therefore, is there a conflict? The ultimate conclusion is there is no conflict, because Ind AS 38 is putting additional conditions. That's all. It's not conflicting with the framework. Framework says certain conditions. Ind AS 38 goes one step further and say we will imply probability also. It's a further conditions added for more pragmatic purpose, more confirmation purpose, and that's why they say it is more specific, and therefore it is appear to be inconsistent, and they are not inconsistent. Hope you got the point. The important distinguishable factor is probability. They are not conflicting. Because probability is only additional criteria, it is not a conflicting criteria. Hope you got the summary point. Read through the solution in detail later. Okay, next. The directors of Fin Limited are particular about the usefulness of financial statements. They have opined that although Ind AS implement a fair value model, Ind AS are failing in reflecting the usefulness of financial statements as they do not reflect financial value of an entity. Discuss the views of directors as regards the use of fair value in Ind AS and the fact that Ind AS do not reflect financial value of an entity, making special reference to relevant Ind AS and conceptual framework. Okay, now what they're telling is this. We are preparing balance sheet. We follow fair value model for valuing the revaluation model, fair value model. Even after following fair value model, Ind AS is a failure. That's what they're telling. Why Ind AS is failure? Because by looking at the balance sheet, I cannot know the financial value of an entity. Ind AS is a failure. It's a waste. We are following fair value model, but by looking at the balance sheet, I cannot obtain the value of an entity. So how do you react? We say, with reference to conceptual framework, the objective of financial statement is not to give you the financial value. It is help you assess yourself, because it is about the futuristic thing. Nobody can give a futuristic guideline. You got the point? The objective of financial statement is to help you arrive at the value, not to give the value as it is. It cannot give you the value. You cannot have a same value for everybody. That's what we say. So treatment of Ind AS, we have Ind AS 113 fair value also. We have various fair value model, like in Ind AS 16, I told you, we can value property, plant, equipment and our revaluation model. All those things also follow it. Ind AS 16 talks about it, Ind AS 38 talks about it, Ind AS 109, Ind AS 113 and so on. So various models, various standards do talk about fair value. But can I value financial value? That's what important point. Although Ind AS makes use of fair value for the measurement, the financial statements are prepared in Ind AS are not intended to reflect the aggregate value. Make a note, Your Honor. Not intended to reflect the aggregate value of entity, as could be the notion among the people. Entity cannot tell, this is my value. The conceptual framework specifically states general purpose financial statements are not intended, again repetition, not intended to show value. Furthermore, such an attempt would not be fruitful as certain internally generated assets cannot be recognized. Instead, the objective is to provide information about the reporting entity which could be useful in existing and potential investors, lender and creditors in making decision of providing resources to the entity. Summary points, did you get it? I'll just focus once more. They do not, financial statements are not intended to show the value. Objective of financial statement is not to show the value, but it will help you. It will provide information based on which you can assess. That's the judgment you have to take. So false statements do not provide the value, they provide only an information about whatever happened in the past. Okay, I hope you got it. Everest Limited is a listed company having investments in various subsidiaries. In its annual financial statements for the year ending March 2002 as well as 2003, Everest Limited classified Kanchenjunga as subsidiary held for sale. Subsidiary held for sale, presented it as a discontinued operation. On 1st of November 2001, shareholders authorized the management to sell the holding of Kanchenjunga within a year. In year to 31st March 2002, the management made a public announcement of its intention to sell the investment, but did not actively try to sell, as it was still operational within the Everest Group. They made announcement, but they are not making a best efforts. Certain organizational changes were made by Everest Limited during 31st March 2003, thereby resulting in additional activities being transferred to Kanchenjunga Limited. Additionally, during the year 2003, there had been draft agreements and some correspondence within the bankers which showed principle that Kanchenjunga was still for sale. Discuss whether the classification as held for sale and its presentation discontinued operation is appropriate by referring to the principle of relevant Ind AS and evaluating treatment of conceptual framework for financial reporting. Ideally, as per Ind AS 105, if you held for sale within 1 year, you should exit. Then only you classify it as held for sale. So you started in 2001. 31st 2 happened, still not sold. 2003 happened, still not sold. But as on this date, it shows that it is still for sale. So what is the proper conclusion? Let's quickly go through it. Is a disposable group, non-current asset for sale, can be identified as assets or sale otherwise in similar transaction, single transaction, directly associated. Okay, that's definition what they've given. Shall be classified as sale if its carrying amount will be recovered principally, though sale transaction rather than through continuing use. Ind AS 105 is particularly strict as far as application of Ind AS considered. Often, decision to sell an asset or disposal group is made well before the criteria are met. Thus, as per Ind AS 105, asset is classified as held for sale. It must be available for sale in the present condition. Subject to terms, the customer for sales or group must be highly probable. For the sale to be highly probable, the appropriate level should be committed to sell. Active program should be there. Marketed for sale. Expected to qualify condition within 1 year. Remember, I told you within 1 year you are expected to complete the sale transaction. Unlikely significant changes will be withdrawn. Okay, in the given case, draft agreements are not specific enough to fit in the points to prove that criteria for held for sale was met at that date. Additional information would be needed to confirm the subsidiary was available for immediate sales, that it was being actively marketed. Further, the organizational changes made by Everest Limited are good indicator that the Kanchenjunga Limited was not available for immediate sale at a point of classification. The fact that additional activities have been given to Kanchenjunga indicate that the change was insignificant. The shareholders had authorized 1 year. There is no evidence that the authorization extends beyond 1 year. Okay. Conclusion: based on information this, the APS conglomerate should not be classified as Everest Limited a subsidiary. Instead of results in subsidiary should be reported as continuing operation. Evaluation in context of conceptual framework. Conceptual framework states the users need information to allow them to assess amount, timing of uncertainty of cash flows. Highlighting the results of discontinued operations separately equips the users with the information that is relevant to assess the discontinued operations. If company has made a firm decision to sell subsidiary, it could be argued the subsidiary should be classified as discontinued operation even if the criteria as held for sale as per Ind AS 105 have not been met, because this information would give more information. However, Ind AS 105 criteria was developed with high degree of strictness classification. Accordingly, this decision could be argument in conflict conceptual framework. I read in quick manner to help you get a point. Let me quickly summarize it. Then if you have any doubts, you ask. Ind AS 105 put some conditions. Ind AS 105 put some conditions. If you want to classify as held for sale, strict conditions are there. If you not satisfy even one condition, you cannot be reported as held for sale. Conditions are there. One of the condition is the sale is highly probable and it must be completed within 1 year. What happened in this problem? Management is not showing intention. Some agreements are there which is not showing the confidence of the management, and also the management is giving some additional activities transferred to Kanchenjunga. If you are selling that subsidiary, why are you giving them additional responsibility? Question arises, right? You made a public announcement, but investment did not actively try to sell. The management did not actively try to sell. 1 year over. In fact, you got the permission from the shareholder only for 1 year. 1 year is over. We don't know whether it is extended or not. Management is not showing commitment to sell very clearly. And additional activities also transferred. Looking at these points, we get a feeling this subsidiary will not be sold. Sale less probable. If it is less probable, we will not show it in the we will not classify it as held for sale. That's what they said. Next point, what does conceptual framework says? This conceptual framework tells you should provide information. What information? So that the users can understand information about the cash flows, future cash flows. Sir, how it makes difference? Let me tell you. If you classify it as held for sale, that means the business will get the money. Accordingly, the valuation will change. One part. If you did not classify it as held for sale, then you will not get the money immediately. The business will be operated by the big company. So valuation of the company will be different. Getting the point? As per conceptual framework, information should be provided to help the users to make a judgment about the cash flows, estimations. So, if you say that it is held for sale, that is good. The users get a clear idea. But you say it is not held for sale, but in the information you say it is likely to be sold to inform the users about the cash flow, that information will be conflicting. So what they say? That accordingly this decision could be argued to be in conflict of conceptual framework. What decision? We will not show it as classified as held for sale, but in the information we say it might be sold. It might be sold. So that is what is the conflicting decision which could be argued. So sometimes we don't have a specific answer. We'll keep it as it is. I hope you got the gist of this discussion. As per Ind AS 105, what is asset held for sale? As per conceptual framework, we have to provide information, and sometimes it can be conflicting. That's the conclusion of the answer. Okay, good. The directors of Giant Limited have received the following email from majority shareholder. They got a mail. Two directors of Giant Limited, a subject measurement. I recently read an article. Sometimes, some directors are having extra knowledge. Directors, now shareholders. Some will have extra knowledge, but half-baked knowledge because of these WhatsApp universities. They'll get something in WhatsApp and they're saying that, oh, this model is good. This information I understood something. So those kind of one of the shareholder who understood something great by understanding this conceptual framework, writing a letter to director. What letter? I recently read an article published in the Financial State Press about the mixed measurement approach that is used by a lot of companies. I hope Giant Limited does not follow such an approach because the mixed seems simply inconsistent. I believe the consistency is paramount importance. Look at the language. Hence, I feel it would be better to measure everything in uniform manner. It would be appropriated if you could provide the further information at the next annual general meeting on the measurement basis, covering what approach is taken by Giant Limited and why potential affect such an approach as investor trying to analyze financial statements, prepare notes for the directors to discuss the issue raised in shareholders email with reference to conceptual framework wherever appropriate. Okay, so basically a shareholder is raising a concern. What concern? He's worried. I don't like this mixed measurement approach. I want my company to follow single approach. What is your opinion? Can the company follow mixed measurement approach? Absolutely yes. According to different requirement, you can follow. These are Indian mindsets. For some people, everything is uniform, everything should be same. No. First of all, we Indians are diversified and we should celebrate it. Be it religion, culture, language, state, whatever it is. Similarly, in accounts also, you cannot paint everything with the same color or same brush. For different requirements, different measurement approach may apply. Same example, what I've taken earlier, I will repeat. If the building is in the heart of the city, office building, revaluation model makes more sense. If the building is at the outskirts of the city where value does not change much, cost model is sufficient. So mixed measurement is not inconsistent. What is inconsistent? This year you follow cost model, next year you follow revaluation model. That is inconsistent. So what do we say? That mixed measurement is applied, is allowed by the respective standards and to be chosen based on the different situations. Inconsistency refers to changes in these methods on a continuous basis. That's what the standard will tell you. Solution is there. You can read through it. Measurement approach implies company selects different measurement bases for its various assets rather than single measurement. The measurement basis should reflect the type of entity and the sector in which it operates. There are criticisms of fixed approach, particularly under IFRS, because investors think its different measurement bases are inconsistent. It is not. It is of our importance to note figures of items cannot be derived by follow one size all approach. That is, you can't paint everything with the same brush. Such an approach may not provide relevant information to providers. Okay, that's a keyword. Rest of it you read. Such an approach may not provide relevant information to the users. So COMSTEL framework states for some estimates, high level of estimation may be required. To that extent, the relevant information may be of little relevance. Anyway, so rest of the paragraph, you read through it. The conclusion of this point, this problem is ultimately you should provide a relevant information to users, which can be achieved by following mixed measurement approach. Okay, so these are the problems which have been added by the institute because of the new framework that have been introduced. Okay, hope no doubts on these things. Good.